The market does not care about your opinion. It only cares about your entry point and your exit plan. Most traders spend 90% of their time predicting where a stock might go and 10% on how to enter. This is the fatal flaw Jesse Livermore learned through bankruptcy, that prediction is a fool's game. Success is not about being right, it is about being certain. He threw out indicators and crystal balls and developed a system based purely on confirmation. He needed the market itself to give an undeniable signal, a command, before he risked his capital. This command is the pivotal point. It is the single most important concept in his entire trading philosophy because it separates the impulsive amateur from the patient master. We begin by understanding why the market creates these pivotal moments. This certainty is born from understanding the hidden psychology of price action. Every price is a psychological battlefield, and the pivotal point is where one side finally surrenders. The pivotal point is the price where accumulated resistance finally breaks. Think of a stock consolidating in a range for weeks or months. During this time, buyers and sellers are fighting each other, creating a psychological standoff. Every time the price touches the high of the range, new sellers enter and existing buyers take profits. This price ceiling is the line of resistance. Livermore recognized that when a stock finally breaks this line on heavy volume, it signifies a psychological shift. The bears have surrendered, their selling power is exhausted, and the buyers are now fully committed. The pivotal point is the moment of maximum conviction and minimum resistance to the move. Do you prefer trading breakouts from consolidation or trading pullbacks? Comment your preference. The pivotal point is not random, it is a deliberate trap designed to punish the early and reward the patient. If the pivot is not obvious and unmistakable, it is not a pivot, it is noise designed to draw you in early. The challenge is distinguishing a true pivotal point from a false breakout. A true pivot is a significant historical price. It must be a level that the stock has clearly struggled to breach on multiple prior attempts, or a level that marks the end of a long accumulation period. Livermore strictly avoided trading minor daily resistance levels. He was waiting for the major pivots, those price points that signaled the move of the smart institutional money. The pivot must be crossed decisively and critically. It must be confirmed by the flow and volume on the tape. If the price crosses the resistance level but the volume is weak, it is a warning sign, a signal that the big players are not yet committed. Waiting for this high-quality signal is the first test of the master's discipline. The market gives you a choice: lose a small amount now or lose a large amount later by chasing the move. The most expensive mistake is the failure to wait for the true pivot. When a stock approaches the resistance level, many traders jump in early, driven by fear of missing out, FOMO. This is the patience penalty. Livermore knew that when you buy before the pivot, the stock often reverses and dips back into the consolidation range, forcing you to take a loss or endure a massive drawdown. The loss is compounded by the psychological stress of being wrong and the lost opportunity to deploy that capital at the correct time. The professional speculators willing to pay a slightly higher price after the pivot is confirmed because that confirmation guarantees a higher probability of success and a tighter manageable risk. What is the hardest part about waiting for a breakout? The boredom or the fear of missing out? Comment below. The execution of the entry itself must be systematic and emotionless to capture the confirmed momentum. Never commit your entire capital to an idea. Commit it only after the market confirms your theory is correct, even when the price crosses the true pivotal point. Livermore did not instantly commit his full position. His entry strategy was a test protocol. He would take a small initial position, perhaps 20 or 25% of his intended size. This small trade served as his final confirmation test. He would watch the price action closely. If the price immediately reversed and failed to hold the pivot, he would liquidate the small position instantly taking a minimal loss at cheap tuition fee. However, the price continued to advance quickly and easily after the entry. The test was successful. This small, successful test gave him the emotional and financial conviction to proceed to the next phase, the aggressive scaling. The risk management in this phase is absolute and non-negotiable. The failure point must be known before the entry. The Sentinel is your defense against your own emotion. It must be placed before the trade, not after the fact. Before the test entry is even placed, the Sentinel stop-loss must be determined. Livermore knew that the pivot is only valid if the price holds above it. If the stock crosses the pivot and then immediately drops back below it, decisively the pivot has failed and the thesis is invalid. Therefore, the stop-loss must be placed just beneath the newly formed support level, the failed pivot. This is the Sentinel Stop, the guard protecting your capital. By setting this stop first, you define your maximum risk before emotion can cloud your judgment. If the trade fails, the loss is small, defined and executed mechanically, ensuring the capital preservation principle is upheld. The successful execution of the test protocol leads directly to the most profitable stage, the systematic scaling. The only time to average is when you are averaging up on a winner that has proven its validity. Once the test entry confirms the move, Phase 5 and the Sentinel Stop is securely placed. Phase 6, the speculator begins scaling up. This is the opposite of the amateur's mistake of averaging down. Livermore would add subsequent tranches of his position as the price continued to advance and confirmed new higher pivots. He would buy more as the price rose, effectively averaging up. This strategy ensures two things. First, the majority of his capital is only deployed into a winning trade. Second, the trade has minimal risk exposure to a market reversal because the position is already protected by profits. Scaling up maximizes the profit potential of the high conviction pivotal move. Livermore used a rule of thumb for scaling. What percentage of capital do you add to a winning position? In your second tranche, comment your scaling percentage. The pivot system is not complete without knowing exactly when the momentum has died. The market always gives you a signal before it reverses. The master is simply paying closer attention. Just as there is an entry pivot, there is an exit pivot or failure pivot. Livermore never held a stock until it gave back all its profits. He looked for the opposite of the entry signal, the decisive break below a newly formed support level. If the stock breaks a recent swing low on heavy volume, it signals that sellers are re-entering the market and the line of least resistance has changed. This is the failure pivot, his command to exit the trade and secure the profits. It is critical to liquidate the position immediately. When this occurs, even if it feels early, the goal is to capture the bulk of the move, not the last exhausting point. The psychological warfare is constant, and the market exploits the emotional attachment to the trade. You must achieve complete detachment from the trade. The pivotal point is a scientific observation, not a religious conviction. The greatest hurdle in mastering the pivotal point is emotional detachment. When the price is moving favorably, the ego whispers to cancel the Sentinel Stop or delay the exit at the failure pivot. This is where the emotional mandate comes in. Livermore demanded that his execution be machine-like. The pivot point is a mechanical signal. It is either breached or it is not. The money management rules around the pivot must be followed without question. You are not trading the stock, you are trading the system. By removing the self from the decision loop, you ensure that the high probability entry is followed by the disciplined management that turns small gains into great wealth. We conclude by integrating this precise entry strategy into the ultimate perspective of the speculator. The pivotal point is the precise moment when uncertainty ends and conviction begins. Use it as your undeniable command. We have mastered the pivotal point, Livermore's ultimate entry strategy. You now possess the knowledge to stop gambling on prediction and start trading on confirmation. The pivotal Point is your sentinel, your signal, and your final confirmation that the market is ready to move in your favor. It forces patience, principle for risk control. Principle 6 and systematic scaling. Principle 7. The master speculator waits for certainty, enters with a test, and manages the trade. Ruthlessly, never guess the future, simply wait for the market to give the command. Embrace the discipline of the pivot, and your trading will never be the same. Trade with the conviction of the pivot point. May your entries be precise and your risk always be managed. Go forth and trade systematically.